So building up on the leverage part, I mean, both of you mentioned buy to let and leverage. And I think the equation has changed because of the high interest rates. Borrowing money at 2 to 3% and then getting a yield of 5% made sense, 6% even for that matter. What are your thoughts on the general trends going forward in terms of yields and capital gains, given that most specialist lenders are now lending around the 6% mark? Do you think there's still money to be made in buy to let at all? Or what are your thoughts?
Shall I go on that?
Yeah, go ahead.
So basically, I mean, I think an interesting point, and actually, I think what we see, because we are a property data company, so we get access to the data of the whole of the UK, and we do these reports for everybody. So I think the general, in general, what you said is correct, but there are still properties out there which are giving you way higher yields than your typical 4-5%. However, there are lesser of such deals. But I mean, I'm talking hundreds of thousands of such properties are available across the country, but it's not very easy to spot some of these deals. But there are properties available. What you would find is as the economics changes, what you start seeing is all these wannabe investors, if I can call them, or people who are actually sitting out on the fence and they want to join the bandwagon. Those people generally would run away when things get tough and then becomes tricky. Not saying that's the right thing to do. It's just that obviously people have a lot of scaremongering and then they just follow that and then don't take action. However, what we see is the more sophisticated investors or people who actually make money in investing are the ones who become really active at these times, where that's when these people would switch from giving the yarn, as I call it, or being gurus, to actually starting to invest themselves. Because when everybody is jumping in the bandwagon, that time they are trying to sell them the dream that how they can make money and then making money. Whereas when the going gets tough, that's where you start to find all these people who are possibly sitting on a few properties but are scared to carry on, and they end up selling their portfolios at much lower prices. So it's more about finding those deals. Can you find those bargains somewhere, and then essentially, although yes, the market is not as buoyant on the sales side, but the rental market is absolutely booming. So essentially your yields are quite high. So yes, the interest rates are going higher. However, the rentals are actually far exceeding some of the like returns people are making on those sides. So I think that is still very much there's still very much money to be made, although the government is obviously adding more and more compliance requirements, etc., which is obviously eating into some of the gains you can make. But if you do it the right way, whether like having the right company structures, etc., in place, that is something you can do. But we are definitely seeing lesser activity from the smaller investors, whereas a lot more activity from the bigger players. So that's kind of where we are.
I completely agree with that analysis. I think at Novi, the amount of transactions we've done in the last 12 months is probably 3 times of what we'd done a year before that.
Absolutely.
So that certainly is the difference between sophisticated investors and individual investors. And I'll take this question again with Vanessa to see what her thoughts are on how interest rates would impact individual landlords or new investors. What do you think, Vanessa? Do you think there's still money to be made?
Yeah, there's still money to be made. What we find is because we work with landlords that are selling, so we every day we're talking to landlords that have built portfolios, and perhaps the thing is, which seems to be a pattern, they've built these portfolios in their own name, right? So as Nitin said, it's about getting the right company structure or the right structure for what you're doing. So when you start, I'm veering off slightly here, I'm slightly off topic of the interest rates. I will come back to that, but you do need to make sure you get the right foundations in place when you start this, and speak to tax advisors and everything to get it right from the start. So these landlords that are selling now, they've built quite large portfolios in their own name. Some of these portfolios are like 60 properties plus. And, that's a massive capital gains bill if you're a higher rate taxpayer. So, but coming back to interest, that's something that's also, you know, some of our landlords aren't leveraged, some of them are, it's a mixture, but the ones that are, maybe with smaller portfolios that have had their properties for about 6 years, you know, where interest rates were so low, now they're rising. They didn't get into this to be in it really for the long term, or it's kind of a similar sort of landlord. It's affecting them, it is. But if you're starting now and you're starting with the right information and the right approach, there's definitely still money to be made. Absolutely. And I mean, yield wise, you know, a lot of the portfolios that we find are 7% and above. There is the odd one which is under that, but there can be other benefits. And it's not always just yield, is it? You know, there's capital growth, as Nitin said as well, there's adding value to the property. So yeah, there's money to be made. Absolutely.
Excellent. So I think we just have a few minutes to go for our this episode. And to summarize the conversation, I'd like to ask both of you, starting with Vanessa and then Nitin, what are your key takeaways? What you advise, what you should be looking to achieve from property investing if you were not a professional landlord?
Yeah, I think don't make things too difficult on yourself when you start. Start with something, you know, as simple as possible, like a buy-to-let, or like using your platform, you know, using platforms like Nitin has as well to find the deals. You know, make things easier for yourself, and get advice from people that are doing it, that are really doing it. You know, really lean into people like that. And don't be afraid to take action. That's really what I would be saying.
So keep it simple is your mantra.
But to start with, you know, I don't mean for the long term, but, you know, do have the end in mind. Cut your teeth on something that's not going to break you, that's accessible, that you can get advice on, that you can manage, and go from there. Yeah.
Nitin, what about you? Your final few cents.
I think very much aligned to what Vanessa said. I guess important thing is identify which strategy you want to be going for. Taking action obviously is important, and having the means to be able to do your due diligence. And I personally, like I mentioned, I mean, I personally don't like to be spending weeks doing that. You should use tech, you should use information which is out there. Focus your time on to other things where you want to add your personal element, but use tech to help that. But at the end of the day, do something which you take action. Do something which you are comfortable with initially, and let yourself grow into it, rather than just jumping into every strategy or every keyword you hear from somebody to just focus on that. So identifying the right strategy, taking action, and having something to help you with your due diligence is what I'd say the key takeaway from here.
So be careful of the internet.
Yeah, absolutely.
Excellent conversation, Nitin and Vanessa, and thank you so much to our audience and those who would listen in later on demand. If you'd like to reach out to Vanessa, Nitin, or myself, look us up on LinkedIn or our business websites. We'll be back again in a fortnight with episode 3 with 2 new faces, again, who will be sharing their experiences on how they did it. And have a lovely week ahead, everyone. See you soon.